Imagine you've started a company and it's taking off, but you need more money to grow. One way to raise that money is by going public and selling stock, which are tiny pieces of ownership in your company. Let's break down how this works step by step. Step 1. Going public. To get more people to invest, you'd start by offering an IPO, initial public offering. This is when your company first sells stocks, pieces of ownership, to the public, making them shareholders. When you go public, your company gets listed on a stock exchange like the NASDAQ, National Association of Securities Dealers Automated Quotations, or the New York Stock Exchange. You'll also need a ticker symbol, which is like the company's nickname in the stock market. For example, AAPL for Apple. Now that you're public, your company's stock starts trading, meaning people can buy and sell it. The investment bank hired by the company issuing the stock looks at the projected demand for the stock and uses that to set the IPO price. If you think the stock is overpriced and will go down after the IPO, it's better to buy it later. The price of the stock is determined by supply and demand. How many people want to buy versus how many want to sell. Step 2, stock prices and movements. Your stock price will change based on what investors think about your company's future. There are a few key things that influence stock prices. Market cap, the total price of a company if you bought all its shares. Big companies have larger market caps. Volatility. This refers to how fast the stock goes up or down. High volatility means more risk, but also more opportunity for big profits. Liquidity. How quickly and easily you can sell a stock for cash without changing its price too much. Kind of like selling a popular toy everyone wants, so you can get rid of it fast without lowering the price. Bigger companies tend to have more liquid stocks, meaning they're easier to trade. And remember, stock prices rise in bull markets when investors are optimistic, and fall in bear markets when investors are pessimistic. These terms come from how the animals attack. Bulls thrust upwards with their horns, while bears swipe down. Step 3. How investors make money. Investors can earn money in a couple of ways. Capital gains. This is when you buy a stock at a low price and sell it at a higher price. Dividends. Some companies share part of their profits with shareholders in the form of dividends. These are paid out regularly, kind of like getting a bonus just for owning the stock. To make the most of their investments, some people practice dollar cost averaging, which means buying the same amount of stock regularly, no matter if the price is high or low. This helps smooth out the effects of price changes over time. Step 4. Advanced terms and strategies. As you get deeper into the market, you'll encounter more advanced terms. Let's break them down. P/E ratio. This stands for price to earnings ratio. The price of a stock compared to how much money the company makes. It tells you if a stock is expensive or cheap based on its profits, like asking, am I paying too much for this company's earnings? A high P/E ratio means a stock might be overvalued. Earnings per share, EPS, the amount of money a company makes for each piece of stock you own. It's a key indicator of a company's profitability. Short selling. This is when investors bet that a stock will drop in price. Borrow a stock, sell it, and hope you can buy it back later for less money. However, this is risky because if the price goes up, they lose money. Short squeeze. If too many people are shorting a stock and the price unexpectedly rises, they are forced to buy shares quickly to avoid more losses, causing the price to rise even more. You can also protect yourself from huge losses with a stop-loss order, which automatically sells your stock if the price drops too far. Or, if you want to buy a stock only when it drops to a certain price, you can use a limit order. Step 5. Different ways to invest. There are various types of investments that can help you grow your wealth over time. Here are a few common ones. ETFs, exchange-traded funds. These are bundles of stocks that track an index, like the S&P 500, and allow you to invest in multiple companies at once. Index funds. Similar to ETFs, these funds track the performance of a group of stocks, like the 500 biggest companies in the US. Mutual funds. These are managed by professionals who gather money from many investors to buy a diversified group of stocks or bonds. Investing in these funds is a great way to diversify your portfolio, the collection of all your investments, without needing to pick individual stocks. Step 6. Market trends and risks. As you invest, it's important to understand some common risks and trends. Black swan events. These are rare and unpredictable events that can cause huge market crashes. Bubbles. A bubble happens when stocks or other assets become overvalued and eventually pop, causing prices to crash. Whales. These are super rich investors who can move the market with their big trades. Dead cat bounce. A brief recovery in a stock's price after a big drop, but it doesn't last and usually falls again soon after. And if you ever hear people talking about FOMO, fear of missing out, It's often what causes people to jump into fast-rising stocks, which can lead to poor decisions like buying during a pump and dump, when people artificially inflate a stock's price only to sell off and cause it to crash. Step 7. Keeping the big picture in mind. It's easy to get caught up in the fast movements of the stock market, but it's important to focus on the fundamentals. Fundamental analysis. This is when investors study how strong a company is by looking at its numbers, like checking how much money it makes, how much it spends, and how healthy it is overall, by checking things like its balance sheet, profit margin, and ROI, return on investment, to decide if it's a good buy. Technical analysis. This is more about looking at past price movements and charts to predict where a stock is heading. You'll also want to pay attention to inflation, how prices of goods and services rise over time because it affects the real value of your investments. The stock market can be complex, but it doesn't have to be confusing. Once you understand the basic concepts like stocks, dividends, shorting, and market trends, you're already ahead of most people. Take your time, use smart strategies, and remember to always keep learning.